Today's video will be of interest to you because it's about notes receivable. See, that was an interest joke. Accountants think that's really funny, okay? Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my very interesting sidekick, Terrence. We are here to put the fun in accounting fundamentals. So the topic of today's video is notes receivable. Now, what is a note receivable? Well, it's simply a promise to pay with specific terms assigned to it. It's just like when you go to buy a fancy new car at the dealership. You're going to be signing a promissory note, and that promissory note is you promising to pay. Well, the other side of that is your bank now has a note receivable. At some point in time, they're going to receive everything that's due for that car plus interest because they let you use their money. So when you have a note receivable, then you're going to have certain things that go along with that. So first of all, there's going to be a maker of the note receivable, which is you, the one who's going to pay. And then there is the payee, which is me, the one who is going to receive. There will be a face amount, which is the principal. So if you spend $10,000 for your car, that will be the face amount. There is a start date. There is a due date or a maturity date, and that is the end of the note. Then there are the number of days or months that are assigned to that note, the length of time you have to pay me back. And then there is an interest rate applied to that. And those are all of the pieces that we need to do the accounting for notes receivable. Okay, I guess Terrence is going to take over the screen now. Fine. We'll talk about that later. So we have a new account alert. Woo, woo, woo. We have an account called Note Receivable, and it's actually a current asset because it's going to be paid within less than a year. We have interest revenue, and the account type is revenue. It's actually other revenue. It will fall below the line for our profit and loss, our income statement. And interest revenue is a revenue account, so it has a normal credit balance. And then we have interest receivable, and that is an asset, and it's going to have a normal balance of a debit. Oh, here, I'm back again. Now, let's say rather than buying a car, what's happening between us is I am loaning you money. Don't ask. I'm not loaning you money. So in that case, I would be handing you the money, and we would be making this journal entry on my books. I would say debit to notes receivable, and I would say cash credit to recognize that I now have less cash because you're doing something with it. So when the terms of the note are done, you're going to be giving me back the cash plus interest. Is we say a debit to cash for the amount of the loan plus the interest. And then we say notes receivable credit to decrease it because you no longer owe me the money. And then we're also going to credit our interest revenue account. So now we've booked the fact that I have interest revenue, that you have repaid the loan, and that now I have all of the wonderful cash. And there you have it. That's everything you need to, right, this is accounting. There's more you need to know about notes receivable. So let's use an example of a 60-day note. So when we start our maker-payee relationship, I'm going to put on my books notes receivable and cash credit when I give you the money. That doesn't change. Let's talk about what does change. Over 60 days, we're going to at least impact 2 months. Maybe it's going to be 3 months over that 60-day period. So because of the matching principle, you keep hearing that from me, the matching principle is important. So because of the matching principle, we've got to get the revenue into the month where it was earned. So if our note receivable crosses 2 months, then we have interest revenue in 2 different months, and we need to make sure that we're booking that so that we have our June revenue in our month of June and our July revenue in our month of July. So under the terms of our note, you're not going to pay me the interest until the note matures. But I still have the revenue. So what are we going to do then? Well, we're going to use our new interest receivable account, and that's going to let us recognize that we have interest revenue, but we haven't received it yet. So we have a receivable account. So we're going to debit interest receivable for the amount of this month's revenue, and we're going to credit interest revenue. Then we're going to do that for every month that's impacted. So if it's a 120-day note or it's a 360-day note, we're going to figure out the number of days in each one of those months and how much interest goes along with that. Then when you finally pay me the money that you owe me, I'm going to get the cash, and that cash is going to include the principal plus the interest. But because we've booked that interest over multiple months, some of it right now is sitting in that interest receivable account, and the current month's interest has not yet been booked, because we didn't get to the end of the month and do the adjusting journal entry, right? So wherever that end point is, we're going to book that final piece of interest revenue. So that's what you see here in this third journal entry. We've got the cash being debited to increase it. We're decreasing the notes receivable because you've paid that. We are decreasing what we've already booked into interest receivable, and we're adding on that third piece, the interest revenue for the current month. And we'll look at a specific example so you can see what that looks like. So let's say that we have a 60-day note. So here's how we're going to figure the interest. We'll say that the note begins on March 15th. So from March 15th to March 31st is 16 days. So in the month of March, we want to make sure that we're booking 16 days worth of interest revenue. And then in April, it's the whole month. So it's 30 days. 30 days has September, April, June, and November. So we're going to book 30 days of interest revenue for April. And then in May, when that note matures, it's going to be 14 days of interest revenue that we want to book, for a total of 60 days. With me so far? Good. Textbook alert. Woo, woo. So for the number of days in a year, some textbooks will use 360, so 360 days in a year. And that's done for ease of figuring interest. In the real world, of course, we would use 365 days because that's how many days there are in a year. But for the purposes of your textbook, you should check to see whether your textbook is using 360 days or 365 days. So let's go into our sample note receivable. So the note amount is $10,000. I'm loaning it to you for 60 days. The start date is March 15th, and the interest rate is 10%. So we're going to base our March interest on 16 days, our April interest on 30 days, and our May interest on 14 days. So on the very first day of the note, March 15th, this is the entry that we're going to make. We're going to debit notes receivable dash your name and cash credit of $10,000. So we've now got this note on our books. That note receivable is going to sit on our balance sheet in the current assets section. Then March 31st rolls around, and we need to do our adjusting entries for the month. And one of those adjusting entries is we need to book this interest revenue. We're not getting the cash for it yet. We're just acknowledging that we have revenue that will at some point come to us, but it belongs in the month of March because that's when it was earned. So we're going to debit interest receivable for $45 and interest revenue credit for $45. And how are we going to figure that out? Well, we're going to take our principal of $10,000, multiply it by our interest rate of 10%, and then we're going to multiply that by the number of days divided by the total number of days. So 16 days divided by 360 days, or 365, depending on what your textbook is doing. So that gives us $45. I rounded up on that. Then the next thing we have to do is at the end of April. We're doing our adjusting journal entries for April. We need to book our April interest revenue. We're going to debit interest receivable and credit interest revenue. And the way we come up with that amount of $83 is we take our $10,000 principal times our 10% interest rate times 30 days divided by 360 days, or 365, and that gives us our $83 of interest revenue for the month of April. Now let's take a moment and look at what's going on in our interest receivable account. So here's our T account. Here's what we've posted so far for interest receivable. We had $45 from the first month, and we had $83 from the second month, and that gave us $128. Remember that number because we're going to need it in the next slide. 128, right? You got it? So then what happens? Well, it's May and the note has come due. On May 14th, the maturity date of that loan, I'm going to get from you the cash, and that's going to be the principal plus the interest. So right now, in our interest receivable account was how much? Right, $128. You forgot, didn't you? $128 currently in our interest receivable account. Now the revenue that we have not yet booked is $39, which we get by taking our $10,000 principal times our 10% interest rate times the 14 days for the 14 days in May divided by 360 or 365 gives us $39 in interest that we have not yet put in our books. So it's not in our interest receivable account. So we're going to empty our interest receivable account for this note for $128. We're going to book the additional revenue for $39. We're going to reduce the note receivable for $10,000. And I'm going to get $10,165 lovely dollars back from you. Thank you very much. Pleasure doing business with you. And that's all you need to know. It's not all you need to know because your textbook is going to throw you a wrinkle. So what your textbook will do is it will say that you now are going to have a note receivable instead of an accounts receivable. So it's going to tell you that you're going to replace an accounts receivable with a note receivable for one of your customers. And the reason that you might do that would be perhaps they got overdue on their bill, they need more time to pay, and you say, yes, you can have more time to pay, but you have to sign a note and there are going to be terms attached to it. You're going to have to pay by a certain date and you're going to pay a certain amount of interest to go along with that. So what we do in that case is if that accounts receivable account is still active, you haven't written it off, then all we're going to do is swap an accounts receivable for a note receivable. And we're going to do that by debiting note receivable, and let's say the company is ABC Co. for $10,000, whatever the amount is. And then we're going to credit their accounts receivable account for $10,000. So now we've taken it out of accounts receivable and we've moved it into note receivable. Everything else still applies. You'll do the same transactions that we did where it was just a cash loan that we did. The same transactions will happen for interest, and then when the note is paid, everything is still the same as far as the journal entries. But of course your textbook will throw you another wrinkle. What if you've already written off that accounts receivable? It's not currently in accounts receivable, it's in allowance for doubtful accounts. And I will link the video for the allowance for doubtful accounts video in case you haven't been through that yet, because you'll need to understand that for your accounting class. So if it was previously written off, now we're going to reinstate that account. So we're going to debit accounts receivable, ABC Co. for $10,000, and we're going to credit our allowance for doubtful accounts to move it out of that allowance account. And then we're going to do the same entry we did as though it had never been written off in accounts receivable. We're going to debit our note receivable and credit our accounts receivable just like we did if there was no write-off involved. And that, for real, is all you need to know about notes receivable. Until next time, stay balanced, my friends.